The president has some influence over the real estate market, but their impact is largely indirect and shaped by the broader economic policies and regulations. The market itself is driven by factors like supply, demand, local market conditions, and financial markets that remain outside direct control of any single administration. Here's a breakdown of how a president's policies can impact the market, as well as the limitations of that influence. Hey, it's Mark here with the Hiller Group, brokered by eXp Realty. My team and I have you covered here along the beautiful Florida Panhandle, where our team has been fortunate enough to serve over 1,350 families alone in the past 10 years, from Pensacola all the way through Panama City. Here are the key areas of presidential influence: the Federal Reserve and interest rates. While the president does not control the Federal Reserve, which independently sets interest rates, presidential economic policies can create conditions that influence the Fed's decisions. The Federal Reserve adjusts rates based on inflation and growth, which the administration's fiscal strategies may impact. What kind of impact does this have? Lower interest rates generally stimulate the housing market by making mortgages more affordable, while higher rates can cool demand by raising borrowing costs. Tax policies and deductions. The president has more direct influence over tax policies, often working with Congress to pass reforms. Changes to tax deductions, such as those for mortgage interest and property taxes, can significantly impact housing affordability as well as demand. In 2017, the Tax Cuts and Jobs Act limited deductions for state and local taxes, otherwise known as SALT. This impacted home affordability in high-tax states and altered incentives for buying homes. Affordable housing initiatives. Presidents can expand access to housing through federal programs typically managed by the Department of Housing and Urban Development, otherwise known as HUD, and through supporting agencies like Fannie and Freddie Mac. What kind of impact does this have? Increased federal support for affordable housing can help lower and middle income buyers enter the market, stabilizing the lower end of the housing sector and stimulating overall demand. Regulation of mortgage and banking practices. Although regulatory standards are largely shaped by Congress and financial oversight agencies, presidential support for specific policies like those under the Dodd-Frank Act can influence lending practices. The president's administration may encourage either tighter or looser lending standards. What impact does this have? Stricter lending standards can enhance stability by avoiding risky loans, while looser standards may encourage buying but also risk a market bubble, as seen during the 2008 crisis. Trade policies and economic initiatives set by the administration can impact the broader economy, including the real estate sector. Tariffs on materials like lumber or steel, for example, raise construction costs, impacting home prices and affordability. What impact does this have? A strong economy with low unemployment and wage growth supports housing demand, while tariffs or other trade restrictions can increase building costs, slowing new developments. Infrastructure investments. Presidential priorities for federal infrastructure investments like improvements in transportation, roads, schools, and public transit can make certain areas more attractive, indirectly increasing property values. An example of this is that investments in urban infrastructure can lead to local boosts in real estate demand as an area becomes more appealing to buyers and investors. While the president can shape policies that create conditions either supportive of or challenging to the real estate market, they do not have direct control over housing market fluctuations. The real estate market is highly cyclical and complex, driven by a mix of local supply and demand dynamics, economic forces, and financial market trends. Key factors like inflation, population growth, state laws, and regional economics also play substantial roles. Ultimately, while presidential policies in areas like tax reform, trade, lending practices, and infrastructure development can impact the housing market indirectly, they do not dictate its direction. The market's adjustments and movements result from a complex web of economic factors beyond the reach of a single administration. Hope you found this video helpful. Hit the like and subscribe button, and we'll see you on the next one.